own a home, you've probably noticed your insurance bill creeping higher every year. According to the Brookings Institution, average homeowners' premiums have jumped more than 30% since 2020. I'll drop the citation in the description below. Sure, some of that is just plain old inflation, but most of it comes down to something bigger. Climate risks that keep spiking higher as each year passes. And insurers aren't just raising prices. They're pulling out of entire states. In California, companies have bailed because of wildfire danger. In the Gulf, some insurers even went bankrupt after back-to-back hurricanes and floods. So if you really want to know how bad climate change has gotten, don't look at the weather forecast. Just look at your insurance bill or, in some cases, your cancellation notice. Are insurance companies the canary in the coal mine? Well, insurance exists to spread risk. Customers pay premiums to share that risk with their insurer, and really, with all the other customers. Think of it as one big pool of money, naturally with some skimmed off for company profits. But when insurers can't make the math work, they either jack up rates or leave the area entirely. It's frustrating, but those moves are also warnings. It's a nonverbal message. Your risks are rising. Sometimes insurers even say the quiet part out loud. For example, the National Association of Insurance Commissioners surveys carriers every year on how they assess and manage climate risks. I'll link to those reports in the description. Major insurers also have to file climate disclosures with the SEC. And reinsurers, the giants like Munich Re, publish their own reports. Surprisingly, those can be scarier than what you hear from governments or climate groups. Here's one. Munich Re reported that more than 70% of worldwide damage in the first half of 2025 happened right here in the US. The cost? $93 billion. Link in the description. But then there's the other side of the story. Because insurers aren't just in the business of managing risk, they're also investors. And in another world, you'd expect them not to bet against their own clients' survival. Here on Earth, different story. In California, for example, insurance lobbyists fought against disclosure of fossil fuel investments. Industry groups also pushed for fewer regulations, and they'll say they need these reforms because of the very climate risk they minimized earlier. You can find plenty of examples with a quick Google search. So why does it seem like insurers warn us 1 minute and minimize the risks the next? Remember the old saying about the canary in the coal mine? 100 years ago, miners actually carried small birds underground. If the bird died, the miners knew to get out. Today, insurers are both the miner and the canary. They sing loudly when they need to justify higher premiums or file reports. But they grow quieter when it comes to their investments. They've thrived in the past because of their talent for forecasting, but unstable weather patterns have also reduced their confidence. And if insurers feel uncertain, we should too. It's a bit like your doctor warning you to quit smoking, then selling cigarettes, vodka, and donuts in the lobby on your way out. The takeaway? We should listen to what insurers say and watch what they do. If there's one thing they're good at, it's forecasting risk, and when they act, whether by raising prices or pulling coverage, that's worth paying attention to. But the contradictions also say something about the nature of the industry, and maybe about a lot of industries in our society. Anyway, I'd like to hear from you. What's been your recent experience with property insurance? Do you think it's tied to your local climate? Or tell me I'm wrong. I'm always interested in new perspectives. Just keep it civil. Thanks for watching. Stay safe. And if you liked this, please subscribe so we can keep in touch.